put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. When marble floors hide bodies. In the gleaming towers of Frankfurt, behind marble floors and mahogany boardrooms, there existed a financial cathedral unlike any other. For over a century, Deutsche Bank stood as Germany's most prestigious institution, a symbol of economic might, a gatekeeper of European finance. But beneath the veneer of respectability, behind the silk ties and corporate smiles, this bank was operating the world's most sophisticated criminal laundromat. They didn't just serve criminals. They courted them. They protected them. They became them. This is the story of how one of the world's oldest banks transformed into a global money-laundering empire, moving billions for Russian oligarchs, Middle Eastern terrorists, drug cartels, and dictators, while regulators watched, warned, and did nothing until it was far too late. The question isn't how it happened. The question is how they thought they'd never get caught. The transformation didn't happen overnight. It happened slowly, deliberately, in the shadows of ambition and greed. By the late 1990s, Deutsche Bank faced an identity crisis. They were a powerful German institution, yes, but they wanted more. They wanted to compete with Goldman Sachs, J.P. Morgan, the Wall Street Titans. They wanted global dominance. And in 1999, they made their move, acquiring Bankers Trust, a troubled American investment bank, for over $10 billion. It was supposed to be Deutsche Bank's gateway to Wall Street glory. Instead, it became their gateway to systematic criminality. What Deutsche Bank's executives didn't realize, or perhaps didn't care to acknowledge, was that Bankers Trust came with a dark inheritance. Hidden within its international operations were networks, relationships, and systems designed for one purpose: moving dirty money across borders with plausible deniability. The infrastructure was already there. The contacts were established. The methods were refined. All Deutsche Bank had to do was choose, shut it down or scale it up. They chose the latter, and they did it with German efficiency. The scheme that would eventually expose them began in Moscow, in the corrupt labyrinth of post-Soviet Russia. Between 2011 and 2015, Deutsche Bank's Moscow branch operated what investigators would later call mirror trading, a technique so elegantly simple it seemed almost legal. Here's how it worked. A Russian client would purchase Russian stocks using rubles through Deutsche Bank's Moscow office. Simultaneously, an offshore entity, often controlled by the same ultimate owner, would sell the exact same stocks in the exact same quantities through Deutsche Bank's London office, receiving payment in dollars or pounds. The trades cancelled each other out. They served no investment purpose. They existed for one reason only: to convert rubles earned through crime, corruption, and tax evasion into clean Western currency, sitting safely in foreign accounts. It was money laundering disguised as legitimate stock trading, and Deutsche Bank facilitated over $10 billion of these transactions. $10 billion of Russian money, oligarch fortunes, embezzled state funds, proceeds from extortion and bribery, washed clean through one of Europe's most respected financial institutions. The traders who executed these mirror trades knew exactly what they were doing. Internal emails later revealed the casual criminality, jokes about the clients, complaints about the workload, but never a single attempt to stop it, because stopping it would mean losing the fees. And Deutsche Bank, by this point, was addicted to dirty money. But Russia was just one revenue stream in a global criminal enterprise. While mirror trades flushed Russian billions through London, Deutsche Bank's other divisions were servicing an even darker clientele. Court documents and investigative reports would later reveal transactions with Syrian weapons dealers, Iranian shell companies circumventing international sanctions, and Middle Eastern entities with documented ties to terrorist financing. In one particularly damning case, Deutsche Bank processed hundreds of millions in transactions for a company later identified as a front for Hezbollah, the Lebanon-based organization designated as a terrorist group by the United States and European Union. The bank's compliance officers had flagged the suspicious activity. They'd sent warnings up the chain of command, and those warnings were ignored. Because here's what most people don't understand about financial crime at this scale. It requires institutional complicity. Individual traders can't move billions through a major bank without management knowing. Compliance officers can't be consistently overruled without executive approval. Risk committees can't repeatedly ignore red flags without board-level decision-making. Deutsche Bank didn't accidentally become a money laundering operation. They systematically dismantled their own safeguards, understaffed their compliance departments, and created a culture where profit trumped legality. Whistleblowers who raised concerns found themselves sidelined, dismissed, or forced out. The message was clear. Don't ask questions about the money. Just when you think you've grasped the depth of Deutsche Bank's moral collapse, another shadow emerges from the darkness, one that connects the bank not just to Russian oligarchs and terrorist financiers, but to one of the most notorious predators in modern history, Jeffrey Epstein. By the time Epstein became a Deutsche Bank client in 2013, his reputation was already radioactive. He was a registered sex offender, a financier with no visible legitimate business, a man whose wealth had no clear source, and whose lifestyle screamed criminal enterprise. Every other major bank had rejected him. JP Morgan had finally severed ties after years of internal debate. But Deutsche Bank saw an opportunity. Between 2013 and 2018, while Epstein was actively trafficking underage girls and operating his island of horrors, Deutsche Bank processed hundreds of suspicious transactions through his accounts. Cash withdrawals in amounts consistent with paying young women, wire transfers to Russian models and Ukrainian dancers, payments to law firms and settlement funds. Deutsche Bank's own compliance systems flagged more than 40 suspicious transactions, including payments to individuals later identified as Epstein's victims and accomplices. The compliance officers documented their concerns in internal reports. They recommended closing Epstein's accounts, and senior management overruled them, repeatedly. Why would a bank facing billions in money laundering fines risk further catastrophe by banking a sex trafficker? The answer lies in the psychology of institutional corruption. By 2013, Deutsche Bank's culture was so thoroughly compromised that ethical considerations had become operational nuisances. Epstein was connected to wealthy and powerful figures. He promised access to high-net-worth individuals. He represented potential future business. The bank's private wealth division, desperate for growth in a post-financial crisis environment, couldn't afford to turn away anyone with money, no matter how that money was earned, no matter what crimes it funded. This is the endpoint of unchecked greed. When a global financial institution becomes morally indistinguishable from the criminals it serves. But institutions don't corrupt themselves. People corrupt them. And at the center of Deutsche Bank's darkest era stood a man named Josef Ackermann, who served as CEO from 2002 to 2012. Ackermann was the architect of Deutsche Bank's transformation from conservative German lender to aggressive global investment powerhouse. He set a target, 25% return on equity, a benchmark so ambitious it could only be achieved through extreme risk-taking. Under his leadership, Deutsche Bank's balance sheet swelled to nearly 2 trillion euros, larger than Germany's entire GDP at the time. They became the world's largest bank by assets, a title Ackermann wore proudly. But that growth came at a cost paid in compromised ethics, ignored regulations, and services rendered to the world's most dangerous criminals. Ackerman's successor, Anshu Jain, continued the pattern. Together with co-CEO Jürgen Fitschen, Jain presided over Deutsche Bank during the peak of its money laundering activities between 2012 and 2015. While Russian billions flowed through mirror trades and compliance officers sent desperate warnings, the executive suite maintained plausible deniability. They claimed ignorance of systematic failures happening across multiple divisions in multiple countries, involving thousands of suspicious transactions. It was a defense that strained credulity. How could the leadership of a sophisticated global bank not know their institution was laundering money at industrial scale? The answer, of course, is that they knew. They simply chose profit over principle, and they assumed, correctly for years, that they were too big, too important, too systemically critical to face real consequences. The regulatory response, when it finally came, proved them partly right. In 2017, British and American regulators fined Deutsche Bank $630 million for the Russian mirror trading scheme. In 2020, they paid another $150 million for failures related to Jeffrey Epstein and other high-risk clients. Additional penalties came for manipulating interest rates, for violating sanctions, for fraud in mortgage-backed securities. By 2023, Deutsche Bank had paid over $18 billion in fines, settlements, and legal costs for various forms of misconduct. $18 billion. Yet not a single senior executive went to prison. Not one. But if you think this story ends with fines and settlements, with quarterly earnings reports and restructured compliance departments, you haven't been paying attention to how power really works. Because scattered along Deutsche Bank's trail of criminality are bodies, some literal, some metaphorical, all casualties of an institution that valued profit over human life. In 2014, a senior risk manager named Eric Benazzi tried to blow the whistle on Deutsche Bank's fraudulent accounting practices, specifically how they'd hidden billions in losses from regulators. The bank retaliated viciously, effectively ending his career in finance. His warnings were ignored by the very regulators tasked with preventing another financial crisis. In 2018, William Broeksmit, a former Deutsche Bank executive who'd risen to senior risk management, was found hanged in his London apartment. The official ruling was suicide, but Broeksmit had been cooperating with journalists investigating Deutsche Bank's ties to Russian money laundering and its suspicious relationship with Donald Trump, to whom the bank had lent over $2 billion when no other institution would touch him. His death came as reporters were closing in on explosive revelations about Deutsche Bank's role in what some investigators believed was a massive Russian intelligence operation to compromise Western political figures. Then there are the invisible victims, the ones whose lives were destroyed by the crimes Deutsche Bank enabled. Every dollar laundered for Russian oligarchs was a dollar stolen from the Russian people through corruption and state theft. Every transaction processed for sanctions-evading regimes extended the suffering of populations under authoritarian rule. Every payment moved for terrorist financiers brought bloodshed closer to innocent civilians. And every transfer made on Jeffrey Epstein's behalf facilitated the systematic rape and trafficking of underage girls. These aren't abstract financial crimes. They're crimes against humanity, enabled by men in expensive suits who convinced themselves that compliance and ethics were obstacles to profitability rather than foundations of legitimate business. The deeper you look into Deutsche Bank's operations during this era, the more you realize this wasn't a bank that occasionally broke rules. This was a criminal enterprise that happened to have a banking license. Internal documents revealed systematic schemes to circumvent anti-money laundering controls. They'd deliberately understaffed compliance departments, ensuring suspicious transactions wouldn't be caught. They'd used outdated software systems, knowing they couldn't adequately flag criminal activity. They'd structured bonuses to reward revenue generation, regardless of source, incentivizing relationship managers to pursue clients other banks had blacklisted. When compliance officers managed to block particularly egregious transactions, senior bankers would simply route the business through different subsidiaries in different jurisdictions where oversight was weaker. Consider the mechanics of institutional corruption that made this possible. Deutsche Bank operated in over 70 countries, with thousands of subsidiaries, branches, and legal entities. This complexity wasn't accidental. It was strategic. The more complex the structure, the easier to obscure responsibility, to create plausible deniability, to ensure that no single person could be held accountable for systematic failures. When regulators in New York discovered problems, the bank would claim those transactions were handled by London. When London investigators asked questions, suddenly Frankfurt was responsible. When Frankfurt demanded answers, they'd blame Moscow or Singapore or the Cayman Islands. It was a shell game played with corporate structures, designed to protect the institution and its leadership from consequences. The Trump connection deserves particular attention, not for its political implications, but for what it reveals about Deutsche Bank's risk assessment. By the mid-2000s, Donald Trump had defaulted on multiple loans, been involved in several bankruptcies, and developed a reputation in banking circles as a toxic client. Most major banks wouldn't lend to him, but Deutsche Bank, through its private wealth division, extended over $2 billion in loans, even while Trump was suing the bank's investment division to avoid repaying a separate loan. He was literally in litigation against one part of the bank, while another part handed him hundreds of millions more. Why? The suspicion, never fully proven but heavily documented by investigative journalists, is that Russian oligarchs close to Putin guaranteed these loans through complex financial instruments, essentially using Deutsche Bank as a mechanism to establish leverage over a future American president. Whether that's precisely true may never be fully known, but what's certain is that Deutsche Bank's lending to Trump made no conventional business sense, unless viewed through the lens of money laundering and influence operations. By 2019, the weight of scandals had become unsustainable. Deutsche Bank's stock price had collapsed from its 2007 peak of over $120 per share to barely $7. Their market capitalization had evaporated by over 90%. They'd failed European stress tests multiple times, been designated as the world's riskiest systemically important bank, and faced investigations in virtually every jurisdiction where they operated. In July 2019, they announced a radical restructuring, closing their entire global equities trading business, eliminating 18,000 jobs, and creating a bad bank to hold 74 billion euros in toxic assets. It was an admission that years of aggressive expansion, reckless risk-taking, and criminal complicity had destroyed shareholder value and institutional credibility. But here's the darkest truth of all. They got away with it. Yes, Deutsche Bank paid billions in fines. Yes, their reputation was damaged. Yes, they had to restructure and downsize. But the institution survived. It's still operating today, still managing hundreds of billions in assets, still serving as a pillar of European finance. The executives who presided over this era walked away with their fortunes intact. Joseph Ackermann retired to Switzerland with a compensation package worth tens of millions. Anshu Jain moved on to other corporate boards and advisory roles. The traders who executed the mirror trades, the relationship managers who courted criminal clients, the compliance officers who looked the other way. Most faced no criminal charges, no jail time, no personal accountability. This is the ultimate lesson of the Deutsche Bank scandal. In modern global finance, institutions are too big to fail, and executives are too connected to prosecute. The fines, however large they appear, are simply a cost of doing business. less than a single year's revenue for a bank of Deutsche's size. They're not deterrents, they're licensing fees for criminality. The system isn't designed to prevent financial crime at this scale. It's designed to manage it, to contain it just enough that the public doesn't demand fundamental reform, to punish institutions with fines while protecting the individuals who actually committed the crimes. Consider what this means for understanding wealth and power in the modern world. When people talk about billionaires and oligarchs, about criminal networks and money laundering, about corruption and state capture, they're often imagining shadowy figures operating in dark alleys and offshore havens. The reality is far more disturbing. The infrastructure of global crime runs through marble-floored lobbies in Frankfurt, London, and New York. It operates with spreadsheets and wire transfers, with compliance reports and risk assessments, with PowerPoint presentations and quarterly earnings calls. The distance between legitimate banking and criminal enterprise isn't measured in ethics or law. It's measured in how much revenue a client generates and how likely the consequences are to exceed the profits. Deutsche Bank's transformation into a money laundering empire wasn't an aberration. It was the logical endpoint of a financial system that prioritizes growth over stability, profit over principle, and shareholder value over social responsibility. Every major bank has paid significant fines for money laundering violations in the past 2 decades. HSBC for Mexican drug cartels, Standard Chartered for Iranian sanctions evasion, Wells Fargo for fraud and abuse, JP Morgan for Bernie Madoff's Ponzi scheme. The pattern is clear. The penalties for getting caught are manageable, but the profits from looking the other way are extraordinary. Until that calculation changes, until individuals face prison time instead of institutions paying fines, the cycle will continue. Today, Deutsche Bank claims to have learned its lessons. They've hired more compliance officers, updated their systems, implemented new controls, and promised regulators that the dark era is behind them. Perhaps that's true, or perhaps they've simply gotten better at hiding it, because the fundamental incentives haven't changed. The leadership structure that enabled systematic criminality hasn't been dismantled. The regulatory framework that failed to prevent this catastrophe hasn't been reformed. And the question that no one in power wants to answer remains. If Deutsche Bank was operating as a criminal enterprise for years, servicing terrorists, money launderers, sex traffickers, and corrupt oligarchs, what other institutions are doing the same thing right now, just more carefully? The marble floors in Frankfurt are still spotless. The boardrooms still gleam. The executives still wear silk ties and speak the language of shareholder value and fiduciary responsibility. But beneath that polished surface, the machinery of global crime still hums, quieter now, more careful, but fundamentally unchanged. Because in the cathedral of finance, the real business has never been banking. It's been power. And power, as Deutsche Bank proved, always finds a way to serve itself, no matter how many laws must be broken, how many lives destroyed, or how many billions laundered in the process. The only question that remains is the same one that opened this dark story. How did they think they'd never get caught? The answer is simpler than you might imagine. They didn't care if they got caught, because they knew that when you're big enough, rich enough, and connected enough, getting caught simply doesn't matter. Subscribe and listen to our next story below.